The crypto supply shock is here. Wall Street just bought 40% of all Bitcoin and Ethereum, and they're just getting started. This is the start of our new financial era, a global arms race to accumulate, to buy and hold as much Bitcoin and Ethereum while there is still time. And as you'll see in the next few minutes, the numbers will soon make it nearly impossible for the average person to own a single Bitcoin again. The supply crunch is real, and it's playing out in real time. So stay with me until the very end, because what happens next and what I share with you will decide who ends up building wealth in crypto and who gets left behind. So we just had our Berlin Wall moment, where the last wall standing between old and new world just crumbled. The SEC's last ETF rule didn't just remove red tape, it flung the floodgates for trillions of fresh capital to flow in. On July 29th, the SEC approved in-kind creations and redemptions for Bitcoin and Ethereum ETFs. For the first time, Wall Street, pension funds, sovereign wealth funds, and insurance giants, as well as massive family offices, can now move real Bitcoin and Ethereum in and out of ETFs directly. The era of slow and expensive workarounds are over. Every share can now be created or redeemed with actual coins, instantly, efficiently. And SEC Chairman Paul Atkins has made it very, very clear that this was about building a rational regulatory framework, one that finally puts crypto on equal footing with other commodities like gold and oil. This approval is not just a formality either, okay? It's not just like writing on random paperwork. It's a green light for Wall Street to operate at full speed in this space. Jamie Selway from the Division of Trading and Markets confirmed that in-kind creation and redemption provide cost savings and make markets more efficient. And this is exactly what the biggest asset managers, pension funds, and endowments have been waiting for. And the last time we saw this kind of infrastructure shift, it was in the gold market when the SPDR Gold Trust launched with in-kind creation. It allowed big banks and funds to move actual gold into the ETFs. Over the next 5 years, that single ETF absorbed more than 1,000 tons of gold, and prices multiplied from around $430 an ounce in 2004 to over 1,800 by 2011. Now crypto is following in the same footsteps, but this time the market is bigger, faster, and digital. And what's really important and at the heart of this matter is the fact that massive amounts of new capital was just unlocked. Pensions, endowments, and sovereign wealth funds now have the tools they need to buy and hold Bitcoin and Ethereum directly and at scale, with the lowest possible costs and the tightest price tracking. And actually, BitMEX research studied more than 10,000 global ETFs and proved that cash-only models, the kind that Bitcoin ETFs have exclusively had so far, typically have tracking errors and extra trading costs. It's not hard to imagine, right? And this typically makes them a non-starter for serious institutions. So in-kind swaps, they shrink these costs down to just a few basis points, which is exactly what massive pools of capital and those who run these massive pools of capital require before moving real money. And tax advantages are another reason Wall Street is rushing in, because with in-kind redemptions, large investors can swap ETF shares for Bitcoin or Ethereum, and they can defer their capital gain taxes, a move that can save millions of dollars for high net worth clients and corporate treasuries. The numbers are already massive too. US spot Bitcoin ETFs have attracted $6.6 billion in just the last 12 trading days, holding a record 1.3 million Bitcoin, which is over 6% of the total supply. Wall Street and major funds have their green light, and the flows are only accelerating. Arms race has begun, and institutional buyers and treasury firms are battling to secure every available coin before the supply runs dry. The total supply crunch is no longer theoretical. It's a direct consequence of a market structure overhaul that now fully favors big money. Now let's get specific about who is leading this wave of accumulation, who's buying all of it, and how huge their purchases have become. Let's take a look at Strategy, formerly known as MicroStrategy. Most of you know this, but for those that are new, welcome. That is the name of Michael Saylor's company, who in many ways has been the sort of Bitcoin accumulation brand ambassador in many ways. Anyway, his company, Strategy, just added another 21,021 Bitcoin to their treasury, funded by a $2.5 billion stretch preferred stock raise. So this now brings their total stash, all their holdings, to 628,791 Bitcoin, acquired for about $46.8 billion, which means they accumulated all this Bitcoin for the average price of $73,277 per Bitcoin. In 2025 alone, so this year already, Strategy has added over 2.46 billion in Bitcoin and has achieved a 25% Bitcoin yield year to date. So their holdings now make up nearly 3% of all Bitcoin that will ever exist. Strategy has a public goal to raise a total of 84 billion for further Bitcoin acquisitions in the next 2 years through 2027. And their buying pressure is only ramping up. Mara Holdings is right behind them too. As the world's largest public holding miner and the second largest corporate BTC holder, second to Strategy, Michael Saylor's company, Mara has reported more than 1.2 billion in quarterly earnings and has increased its Bitcoin treasury by 170% year to date, now holding 49,951 Bitcoin. They have also raised approximately 940 million to keep expanding their holdings, their stash, and operations. Next up, we have 21 Capital, guys, backed by Cantor, Fitzgerald, Tether, SoftBank, and Bitfinex. They now hold at least 43,500 Bitcoin, already outpacing their original projections. And Tether alone has sent more than 37,000 Bitcoin to their addresses this year. And just days ago, another 5,800 Bitcoin was added ahead of their public listing. So the numbers are adding up fast. And according to HODL 15 Capital, 40% of all Bitcoin that will ever exist is now tracked among the top public and private treasury holders, miners, and institutional wallets. That number keeps climbing, making it rare for anyone to even hope to own a full Bitcoin again. Billionaire Bill Miller even said he believes every company will eventually become a Bitcoin treasury company. And that's really not hard to see, which basically means the future economy all revolves around holding Bitcoin. That's wild. So it's not just a few whales. The arms race has gone global. Strategy is loading up with billions, and miners are holding more than ever. And even medium and small businesses are getting involved. The biggest players on earth are treating this as a race to secure supply. And the signal is crystal clear. Bitcoin's future is in long-term holders' hands, which is good. It means they're not going to sell it, which secures Bitcoin's price, really. That said, let's shift gears a little bit because the supply shock story goes beyond Bitcoin. Ethereum and select altcoins are seeing historic inflows from treasury firms and institutions. Standard Chartered reported that Ethereum treasury companies could end up buying 10% of all Ethereum in circulation. SharpLinks Gaming's 780 million Ethereum allocation in July shows the kind of firepower entering the Ethereum market from outside the traditional crypto crowd. Some treasury firms are even branching out beyond the two giants. One $500 million treasury firm made headlines this month for choosing BNB as a core asset, citing BNB's superior 5-year Sharpe ratio and lower maximum drawdown compared to every other major altcoin and even the S&P 500 and NASDAQ. BNB just hit a new all-time high at $859 per token a few days ago, signaling how diversified institutional demand is for shifting markets. BNB stands out not just for price transaction either, but because of its risk-adjusted returns. Over the last 5 years, BNB's Sharpe ratio reached 2.5, outperforming Bitcoin, Ethereum, Doge, XRP, ADA, or ADA, depends on how you say it, HBAR, and Link, and even major stock indexes. The Sharpe ratio is a widely used metric in investing that measures how much return you get for the risk you're willing to take. And a higher Sharpe ratio means you're earning more profit for every unit of risk, which is especially important to large investors who want growth but need to manage their volatility. When treasury firms and institutional investors see a high Sharpe ratio, it signals to them, it tells them that an asset like BNB is not only delivering strong gains, but is also doing so in a way that's more stable and reliable compared to other options. This is why the Sharpe ratio matters in decisions about which crypto assets to hold over the long term. And according to Coinbase research, the total altcoin market cap, excluding stablecoins and Bitcoin, has doubled since April 2025. For the first time in months, Bitcoin dominance just closed below its 200-day moving average. Historically, a sign of incoming capital rotation into altcoins and the possible start of a new altcoin season. However, analysts are watching open interest dominance ratios closely. A spike in altcoin leverage can forecast sharp corrections, as we saw during recent liquidations. The new institutional money is driving a smarter, risk-managed altcoin rotation, which is really, really good. And is actually going to drive more adoption because people are going to see it's being managed, that the best risk-managed tokens are leading the way. And that's going to be a good signal for new investors too. So for the first time, you and I are seeing the biggest pools of money in the world diversify into more than just Bitcoin or Ethereum. The supply crunch is now spreading to the rest of the crypto ecosystem. So we see how the convergence, or the integration between traditional finance and crypto is no longer just a speculative, far-fetched dream. It's happening in real time. JP Morgan, the world's largest bank with $4 trillion in assets, is now partnering with Coinbase to make buying crypto as easy as using your bank account. Soon, users will be able to use Chase credit cards on Coinbase, redeem reward points for USDC, and directly link Chase accounts to Coinbase wallets. The walls between TradFi and crypto are dissolving, guys. This is what I was talking about in my intro. We're also seeing Kraken, another major exchange, seeking to raise $500 million at a $15 billion valuation ahead of its potential IPO, underscoring or highlighting the surge of institutional and public market interest in crypto infrastructure, all while the White House is releasing its official roadmap for a golden age of digital assets today. A new report acknowledges the need for a federal tokenization framework and sets up the tone for market structure legislation. So while there's no mention yet of a Bitcoin reserve, the document makes it clear that crypto is now a pillar of the national agenda, as it should be. Regulatory clarity is fueling Wall Street's confidence, and as Bloomberg notes, that crypto treasuries are adopting Wall Street's own playbook, leveraging public markets, preferred stock raises, and sophisticated balance sheet tactics to bring even more money into crypto. So the rails are now being built. The players are in place. Wall Street, TradFi, DeFi, and Washington are moving in unison. Now let's talk about market signals. Altcoin markets, we know, are going through a period of high excitement, but this is also when caution and selectivity, become critical. With open interest dominance in altcoin derivatives and elevated levels, history shows that sudden corrections and liquidations can follow, even in some of the strongest projects and tokens. The total altcoin market cap has doubled since just April this year, but the surge in leverage has made these assets especially sensitive to fast-moving drawdowns. This is a time when smart investors take risk management seriously and avoid chasing every new trend, which is what you need to do too. Even the best projects are not immune to temporary setbacks or corrections in these conditions, and the market can move quickly when excess leverage is flushed out. So if you want to be prepared for the right entry points, I would just say, and I would recommend that you subscribe and turn on the notification bell, because this is what we're getting into in my videos. I'm trying to warn you and show you all the signals and tell you what is happening in the big picture and in the crypto market specifically, so that you know how to navigate and also how to take advantage of good opportunities when they enter the market. And I'll share pros and cons with you. That's my commitment to you, because I think it's only right. But now let's shift gears again and talk about the next phase, okay? The acceleration of institutional adoption is reshaping the entire crypto landscape. But this is not just a shift in who holds Bitcoin and Ethereum. It marks the arrival of a new beginning, of a new phase, where digital assets are becoming foundational pieces, okay? The foundation of global finance, okay, for the world, all as treasuries, miners, and even corporations build their positions, and traditional finance infrastructure now directly connects with crypto. The environment is changing for everyone involved. And for those who have been following these trends, it is clear that we are moving into a period where access to new supply will only get more competitive. The strategy playbook has moved from early adoption and speculation, okay, to disciplined accumulation and strategic timing. So there's been a shift in who wins and how. So those who stay informed and focused will be in the best position to benefit from this transition. So if you're looking to navigate this new era of scarcity and opportunity, it has never been more important to be locked in, okay, focused, following the data, knowing where you're getting your information from to start with. And it has never been more important to lean into understanding signals and market structures. You don't have to be a pro at it, but it is important to open your mind and try to absorb this information, because eventually, like learning anything, like riding a bike, it does become natural, and you see a chart and you can understand the pattern you're seeing. So anyway, guys, I love you guys very much. That's a wrap for today's video. Join my community. The link to join is below. We are going to be running some in-community campaigns, and I will start sharing early releases or glimpses or sharing unique video content just for my community. So join my Telegram community. And anyway, that's a wrap. Take care, and I'll see you guys in my video tomorrow. Ciao.